What if your $10,000 could grow into something much bigger without needing to chase risky stocks? Well, Fidelity has some of the best index funds out there, funds that have quietly been helping people build serious wealth. Whether it's tech, healthcare, or consumer staples, these funds have delivered solid returns year after year. So which are these index funds that you should really be paying attention to if you want the most bang for your buck? Well, let's find out. 1. Fidelity MSCI Consumer Staples Index ETF, FSTA. Let's kick things off with the Fidelity MSCI Consumer Staples Index ETF. Let's say you invest in companies that are part of your everyday routine, food, drinks, and household items. With names like Procter & Gamble, Walmart, and Coca-Cola leading the charge, this fund is all about essentials. And the beauty of it is that these essentials are always in demand, no matter what's happening in the world. That's why FSTA is known for its stability and steady growth. And it's not just talk. History backs it up. During the 2008 financial crisis, while the S&P 500 took a 38% dive, the consumer staples sector, including funds like FSTA, only saw a 15% drop. That's a massive difference when you're looking for security in tough times. The same goes for the COVID-19 pandemic in 2020. While the world was in chaos, FSTA still managed to return 11.02%, giving investors a solid buffer during one of the most volatile markets we've ever seen. Now, let's talk about what this fund can do for your money. Historically, the index fund has delivered an average annual return of 8.2%. So if you invest $10,000, after 2 years, it could grow to $11,713. Stick with it for 10 years and you're looking at $22,019. And if you stay in for 20 years, that $10,000 could balloon to nearly $48,715 thanks to the magic of reinvested dividends. And it gets even better. FSTA has a 2.37% dividend yield, so you're not just waiting for growth. You're earning consistent income along the way. That's why this fund is such a great option for anyone looking for both long-term stability and reliable returns. 2. Fidelity MSCI Consumer Discretionary Index ETF, FDIS. Unlike the essentials we just covered, the Fidelity MSCI Consumer Discretionary Index ETF is all about tapping into the fun stuff, the luxury items, entertainment, and leisure activities that people splurge on when they've got extra cash. It's focused on non-essential goods, the things we buy when times are good and we want to treat ourselves. It's packed with some of the biggest names in the consumer world. Think Amazon, Tesla, and Home Depot. These companies thrive when consumer spending is strong, making this fund a great play during economic booms. In fact, looking at individual holdings, Amazon alone makes up a massive 20.67% of the fund's total assets. Tesla comes in next, followed by Home Depot, with each contributing to the fund's strong performance when the economy is thriving. By the way, do you know that the top 10 holdings account for about 55.6% of the total assets under management? It typically means the fund is heavily influenced by these big players. When people have extra money to spend, these brands see explosive growth, and that's exactly where FDIS shines. Historically, the fund has returned about 14.6% annually, which is pretty impressive. So if you were to put $10,000 into this fund, after just 2 years, you could see that grow to $13,371. Stick with it for 10 years, and you'd be looking at $39,076. As for dividends, FDIS does offer a yield, but at 0.75%, it's not exactly a standout. But here's the thing, it doesn't need to be. This fund focuses more on growth. So if you're someone looking to capitalize on the next economic boom, FDIS is definitely worth considering. 3. Fidelity MSCI Healthcare Index ETF, FHLC. One thing about health is that it doesn't wait for the perfect moment, and it certainly doesn't care about the state of the economy. We all find ourselves needing health care at some point, and it's one of the few things in life we can't control. And that's what makes the Fidelity MSCI Healthcare Index ETF such a solid investment. No matter what's going on in the world, healthcare will always be essential. This fund doesn't just dip its toes into the healthcare sector, it's fully committed, with nearly 100% of its portfolio focused on healthcare giants. We're talking about companies like Eli Lilly, which alone makes up 12.33% of the fund. And then there's United Health Group and Johnson & Johnson, which are all heavy hitters in the industry. In fact, the top 10 holdings account for about 50.13% of the fund's assets, giving you a direct line into the companies driving the future of medicine and healthcare. Now imagine putting $10,000 into FHLC with an average annual return of 10.1%. After just 2 years, that investment could grow to $12,122. But here's where FHLC stands out even more. It's a cost-efficient way to invest in the healthcare sector. Fidelity is known for undercutting its rivals on fees, and FHLC is no exception. The annual fee is just 0.084% compared to the Vanguard Healthcare ETF, which charges 0.1% per year. That might seem like a small difference, but over time those savings add up, especially for investors who really love to pinch pennies. And if you're trading through Fidelity, you can buy and sell FHLC commission-free, which means even more savings in your pocket. On top of that, FHLC offers a dividend yield of 1.32%, so you're earning income while your investment grows. It's rare to find this blend of growth and security, but healthcare consistently delivers. The industry marches forward regardless of the economic climate, and FHLC gives you a way to tap into that resilience. 4. Fidelity NASDAQ Composite Index ETF, ONEQ. If you're excited about tech and innovation, then the Fidelity NASDAQ Composite Index ETF is definitely worth your attention. This ETF is all about the future. It's packed with some of the most forward-thinking, game-changing companies on the planet. We're talking about Apple, Microsoft, Nvidia, Amazon, Tesla, the giants driving technology, innovation, and the way we live and work. ONEQ gives you a front-row seat to this high-tech revolution, making it a solid choice for anyone seeking serious growth potential. Apple alone makes up about 11.96% of the fund's total assets, followed closely by Microsoft and Nvidia. With these high-tech powerhouses leading the charge, ONEQ is primed to capitalize on the explosive growth of the technology sector. The heavy concentration of assets in such innovative companies means you're investing directly in the future of tech, and that's where the real growth potential lies. ONEQ has averaged an annual return of 17.2%, and the numbers are impressive. If you put $10,000 into this ETF, in just 2 years, your investment could grow to $13,736. After 10 years, that $10,000 could be worth $48,896. As for dividends, ONEQ provides a modest yield of 0.53%. While it's not focused on income, that's not why you invest in this fund. The real appeal here is the potential for major capital appreciation. If you're looking to ride the wave of technological advancements, ONEQ is a fantastic way to tap into the dynamic growth of tech and innovation. 5. Fidelity MSCI Information Technology Index ETF, FTEC. Undeniably, growth-focused ETFs have the potential to deliver impressive, market-beating returns while offering solid diversification. One standout in this space over the past decade has been the Fidelity MSCI Information Technology Index ETF. For investors who are looking to capture the rapid growth of the technology sector without putting all their eggs in one basket, FTEC offers a perfect balance. The Index ETF is not only a powerhouse in the tech sector, but also a cost-effective one. With a light expense ratio of just 0.08%, it keeps fees low, which is crucial because higher fees can eat into your returns over time. That's not something you have to worry about with this Fidelity fund, making it an attractive option for long-term investors focused on maximizing their returns. And speaking of returns, FTEC's performance over the past decade has been nothing short of spectacular. The fund has risen in value by around 440%, easily surpassing the S&P 500's gain of 170% during that same period. Even compared to the popular Invesco QQQ Trust, which invests in the top 100 non-financial companies on the NASDAQ, FTEC comes out ahead. With dividends included, the total return for FTEC over the past 10 years is an impressive 505%, compared to 435% for Invesco QQQ and 225% for the broader market. If you had invested $10,000 in FTEC a decade ago and reinvested those dividends, your investment would now be worth over $58,000. That's the kind of growth that makes FTEC not just a great choice for tech enthusiasts, but a smart investment for anyone looking to build wealth over the long term. The reason Fidelity MSCI Information Technology Index ETF has performed so well lies in its concentrated exposure to top-performing tech giants. The fund's top 3 holdings, Microsoft, Apple, and NVIDIA, are the same as those in the Invesco QQQ Trust. However, the key difference is how much FTEC allocates to these stocks. Fidelity's tech-focused fund has allocated more than 44% of its assets to these 3 tech leaders, compared to less than 23% for the Invesco QQQ Trust. This greater concentration in high-performing stocks is a significant driver behind FTEC's outstanding returns. Even though FTEC holds more than 300 stocks, it's less diversified at the top compared to the Invesco QQQ Trust. This lack of diversification among its top holdings works in its favor when those stocks, like Microsoft, Apple, and NVIDIA, are outperforming the broader market. Essentially, FTEC's strategy of heavier exposure to these tech behemoths has allowed it to capture the explosive growth and innovation in the tech sector, leading to remarkable returns for investors. When the biggest names in tech are thriving, FTEC's structure allows it to magnify those gains, which explains why it has outpaced both the S&P 500 and the Invesco QQQ Trust over the past decade. When it comes to numbers, it has delivered average annual returns of 21.8%, which is quite impressive. And that's it. So what do you think about these ETFs? Which one is your best option and why? Let us know in the comments below. Also, if you found this video helpful, give it a thumbs up, subscribe, and don't forget to turn on the notification bell for more amazing videos like this one.